Hello, Louis Yanis here. I hope you're having a great day. I was thinking about three questions that every single investor should ask themselves. These three questions I think should be asked primarily because people are getting complacent. I want to make sure that you really get this. If you're an investor, if you have money in the markets, if you're investing in your 401k or whatever, you have stocks and bonds. And I would say primarily if you have an investment portfolio of 500,000 or more, maybe $1 million or more. There's three questions I really think every investor should ask. The first question is, should a portion of your portfolio be exposed to the returns and volatility associated to the markets? So, should a portion of your portfolio be exposed to the returns and volatility associated with the markets? So, what I mean by that is, should you have investments that will go up when the stock market goes up? And the obvious answer to that is probably yes, for the most part. You should have a portion. The question is how much, right? So that's the first question. The second question to ask is, what would you expect that portion of your portfolio to be? How much of that portfolio would you expect to be actively managed during a period of market volatility? So, in other words, what percentage of your portfolio should be managed in a way where you would be reducing market exposure when the markets get volatile? What percentage would that be for you? And then the third question would be, should a portion of your portfolio exclude the market movements entirely, right? Like it's not affected at all related to stock and bond markets. And I think the answer to all three of these questions is yes. You want to have some of your money in the markets, stocks and bonds, obviously well selected, but you also want to have some of your money that's actively managed, where there's money that you will reduce exposure when market risks get higher and increase exposure in stocks and bonds when the opportunities are more abundant, right? And so it's a matter of degree. How much do you want to have exposed in the markets, and how much of it do you want it to be active? How much do you want it to move up and down relative to the market? So, for example, when you have a situation where we're going into a recession, what percentage of your portfolio should be reduced as those market increases, the market's risks are increased? Is it 10% of your portfolio? Is it 20% of your portfolio? Is it 50% of your portfolio? And that last question is, what percentage of your portfolio should be excluded from market type returns? And what I'm talking about there is what percentage of your portfolio should be like an alternative investment class, asset classes that are not correlated and don't move up exactly up and down with the markets. And what percentage should that number be? Now, we've done a lot of research on those three elements. You can buy flat out index funds to track the market 100%. Does that make sense? Well, sometimes it does, but there is definitely research that shows there should be a component that's active, and that's in particularly during market volatility. So what is that percentage that you should put? And then the third thing would be, how much of that portfolio should be in non-correlated strategies? Non-correlated strategies. And then the answer to those questions is really, it is personal. It is for different investors. Now, what we find is the wealthier our clients, $5 million or more in assets, there tends to be a desire to have more money that are in actively managed components as well as non-correlated components. And definitely a big proportion also long only or in the market itself, but well selected investments. But there is a desire to have some active management, and a lot of people are not set up for active management. And this is kind of concerning, I think, right now. And I've been talking about this quite a bit lately. You may have noticed, and if you've been following me. And if you haven't been following me, you should go back and go to our YouTube channel and listen to some of the things we've been talking about. But we've been warning people. Today, the market's down quite heavily. Um, we've been warning people to start thinking about this. The active managed component makes a lot of sense. Now, in my new book, The Financial Freedom Blueprint, 7 Steps to Accelerate Your Wealth, that book is expected to launch November 16th. I've talked a lot about that. I'll be doing podcast interviews. I'll be doing some speaking engagements on this. And I'm also launching a podcast called The Market Call podcast. And that's all being put into the works right now. I'm going to be going through some of these things more step by step. But my goal really in all of this discussion is to help people make smart decisions with their money and to help people be more successful with their investing, not only just in good times, but completely when the markets are good or bad. It doesn't matter to me whether the markets are good or bad. But what matters is that we try to earn a rate of return that is reasonable over the long haul, and that we protect capital and that we grow our capital above the inflation rate. Because one of the things that's happening right now is, and it's always the case, inflation is always eating away at our money, so is taxes. So that's my message today. Ask yourself those 3 questions and ask yourself, are you doing anything about that yourself? How are you managing those 3 things? How much do you want to have exposed to the markets in general? How much should be actively managed? How active do you want to manage exposures to the stock market and the bond market? And what percentage of your portfolio should be non-correlated, not related to the markets in general? And that's a whole nother discussion. But ask yourself those 3 questions. If you want to know more about anything regarding your portfolio, if you want to have a review of your portfolio, you can always go to our website and you can always click on schedule a call. And if you schedule a call, you will have a phone call, and we will discuss your portfolio, and we can actually put your portfolio into some diagnostics so that you can see exactly what exposures you have. You can see what's good about it, what your expenses are, if there's any unnecessary taxes, and compare that to your risk profile and see if that makes sense to you, or if maybe you should make some adjustments. That's all I have for you right now. I hope you guys are having a great day. Be sure to ask yourself those 3 questions because it's going to make a big difference to your wealth. Have a good day.